Good morning, everybody. Welcome to Windsor's live daily market outlook for Monday, 14th of January 2013. The week starts with a strong risk appetite as the trading environment basically seen risk appetite dominating, continues to dominate in the markets, reflected not just by clean break of euro above important 133 barrier, but also dollar yen continuing to travel north with 89.66 seen so far after breaking psychological 90 barrier and seeing potential for a 89 barrier and seeing potential for a test of next round figure and psychological barrier at 90. The sterling remains within the sideways movements during the Asian session after last Friday's failure to regain our upside target and psychological barrier at 162, with now more focus seen on the 161 support that so far continued dips, but seems that weakening technicals will see another attack at this support and probably break here to trigger further easing and the failure to confirm the top at 162.77. Dollar Swiss is still holding above important 91 support, but heavy pressure is evident, and unless we go above 92, then more focus here is again seen towards 91 and the base at 92.00. Crude oil remains well supported, mainly due to the improved data that came recently, especially from China, that give additional boost, and of course with the lower production and the fears of a possible further reducing the production, as Saudi Arabia announced last week that they dropped their December's production by 5%. That's all supportive for the energy prices, and the oil so far February contract reached 94.68. This was the high of last week, with the current consolidative action seen being contained at initial 92.64 support. From the commodities, the gold is still ticking higher following last Friday's dip to 16.53, just ahead of our initial 16.50 support, with the 16.69 seen so far again approaching important 1668, 1670, and then 1678 barriers that might open way for a extension towards psychological first previous peak at 1694 and psychological 1700 barrier, as the near-term price action of recent low at 1625 still remains intact, and the near-term outlook is still aligned towards the upside. From important today releases, today is the comment of the speech of U.S. Fed Chief Ben Bernanke that is due at 21:00 GMT, and with regards to quantitative easing in the United States, and despite it has become a normal theme which has resulted in a well-respected view by certain sectors of market over possibility of a less responding dollar to further easing. The truth is that by the reaction of the US dollar on January 3rd, when the December FOMC minutes sparked speculations that the Fed could end its quantitative easing program by year end, the market still remains very much sensitive to Fed official speeches in order to optimize one's strategy. In this regard, the main event, as I said at the beginning of the week in global financial markets, will be addressed by Fed Chairman Ben Bernanke, who will be speaking at the University of Michigan at the time, as we said, at 21 GMT. And this is opening our today's events calendar to see what are the events due to be released today. From overnight session, job advertisements from Australia came at disappointing minus 3.8%, lower than minus 2.9% of the previous release of October. Home loans from Australia dipped unexpectedly by 0.5% compared to forecast of increase by 0.5% and 0.1% seen in the month of October. German wholesale price index. Unfortunately, we do have there is duplicated. Anyway, came at 0 compared to 0.5% increase, but still above minus 0.7% release of the previous release of month of November. Still to come industrial production from Italy due at 9 o'clock GMT, and then Eurozone industrial production for November. Monthly release is expected to show increase by 0.3% in November compared to draw of 1.4% in the month of October. Improvement according to the forecast would be another good signal among the other positive signals that came recently. And despite, of course, the comments from ECB, I do apologize, ECB chief Mario Draghi, who basically made a lot of movements in the market last Thursday following the comments following the bank's decision to keep the rates unchanged, and despite negative overall tone still persisting in the European Union economy, some positive comments gave additional boost to the single currency as there was no lowering interest rate. That is another first significant point, and the other one that Mario Draghi said that likely that the worst is behind us, and the worst happened in 2012, and we can expect a slight picking up of the Eurozone's economy in the year 2013. Of course, miracles not to be expected, but some positive movements are signaled, and this basically keeps the positive sentiment in the market, especially regarding the Eurozone, euro, and the other riskier assets that are now fully in play. From Canada, Bank of Canada Business Outlook survey is due at 15:30 GMT, and then the top release for today is the Fed Chairman Ben Bernanke's speech at 21:00 GMT, and that's basically the most important releases for today, 14th of January 2012, and we're going to take a look at the technicals to see the latest movements and the forecasts for the next 24 hours. The euro remains well supported as the pair ticked to 134.02, basically tested our next upside target and psychological barrier at 134.00, with expected reaction of immediate pullback seen at the early hours of European session, as 134 as psychological barrier is seen capping at the moment, and of course not that easy break would occur, and also the reversal is now pushed, also supported by overextended conditions in 1 and 4 hour chart. Hourlies are already pointing lower. We can see that RSI emerging out of the overbought territory, and all other indicators are now pointing lower. That sees scope for some corrective action, of course preceding the stronger fresh rally, as the overall picture remains firmly bullish at this point, and this is especially seen on the daily chart that sees room for a possible further extension higher. Back to the lower time frames, initial support that has already been dented at 133.64 last Friday's high, and now testing 133.50, the 20 days exponential moving average ahead of 133.30, which is last Friday's intraday low. And of course we have more significant 133.00 as a previous stronger resistance, now acting as good support. I would say ideally any dips should be contained somewhere around these levels, 133.00, 132.80, 132.70, where we have ascending 55 days exponential moving average. That will keep the immediate bullish structure in play for possible fresh stretch higher. And on the upside we have the targets at 130 on a clear break above 134. There are 134.85. I think we can see it on the weekly chart. This is the high of April 2012, and then we have 134.90 that marks a 50% retracement of the longer term descent from 2011 peak at 149.38 that bottomed at 120.42 in July 2012, and this is 2012, so also a yearly low, along with the 135.00 as psychological resistance and the 135.25 weekly 200 days moving average. So basically around 135 we have a next target and quite a strong resistance, but of course the corrective action is seen preceding a fresh rally, and ideally the dips should be contained somewhere above, somewhere at 133 zone, while any break lower would risk further retracement, especially if we talk about 132.47. This is the higher platform of last Friday, the lows of the last Friday, and a break below this level could be a trigger for some stronger corrective action, and would signal a temporary top at 134.00. For now, the bullish structure remains intact, and mild corrective action, ideally somewhere to 133, as we said, is seen containing a current reversal in order to keep the bullish structure intact for a possible fresh attack at 134.00, and then a possible stretch at 135.00, as recent rally driven mainly by fundamentals, comments from European Central Bank, and overall positive sentiment in the market keeps the upside focused for the single currency in the near term. British pound, from the other side, lost traction following a recovery rally from 159.91, 160 strong support zone that failed at 160.177, just ahead of 162.00 next target and psychological barrier. As we can see, ADX is showing now bears gaining pace on the hourly chart, and also on the 4-hour bulls are giving way for more bearish action. Currently, the pair is congested between approximately 161.50 and 161.00 levels, with the 161 generally holding the downside. There was a spike lower on Friday to 160.88, but we can say that 161 so far contained the dips. Weak hourly studies now see more risk towards the downside as the price attacks 161.15. 55 days exponential moving average. Basically, break below 161.00, 160.88 would be a signal for a fresh weakness. We're talking about also 50%, approximately 50% retracement of the initial rally from 159.91 to 161.77, and this will sideline bulls, near-term bulls of 160, and refocus the 160 as a stronger support for possible retest. More positive tone is still seen on the 4-hour chart, especially that price action holds above 20 and 55 days moving averages that are approximately at 161.10 zone, but currently sideways moving 20 days one fails to cross higher and makes the bullish crossover as the price slides lower, and this increases risk of possible break below 161 and 160.88. That will shift risk again towards the downside, and signal basically lower top at 161.77. Conversely, holding above 161 and the clearance of 161.77 initially, 50% retracement at 161.85 and more significant 162 would provide temporary relief, and probably would open way for some stronger retracement, stronger corrective action of the down move from 163.80 down to 159.91. Daily structure is losing traction, as we can see that most of indicators are in the descending mode, with the still negative bearish momentum being in placing. Again, more risk towards the downside, along with the spike lower on 160.88 last Friday. We have the 90 days moving average currently at 160.79, acting as a good support. Below this 160.61 is the 55 days one, as the lower time frame 155 days crossed already below the 90 days one, despite price holding above them. This is seen again as a more negative signal in the near term, as hourly structure is hourly indicators are losing traction, and basically only holding above 161 will still keep some hopes for possible fresh attack higher. Otherwise, break below 161, 160.88 would shift focus again towards strong support at 160.00. Dollar yen remains in the strong uptrend following comments from Japanese new Prime Minister overnight, who said that basically the Bank of Japan should consider maximizing employment as a policy goal on top of its current price stability mandate, and also commenting that in the initial target, inflation target should be set at 2%. That keeps the dollar strongly supported against the Japanese yen, and basically the pair hit fresh 2.5 years high at 89.66 so far. This was seen overnight during the Asian session, ahead of 90.00 as a psychological round figure resistance, and our next upside targets. Corrective easing seen on the overbought lower time frames studies sees good supports at initially at the initial one basically has been already dented at 89.34 along with the 20 days exponential moving average, with the 89.10, 89.00 seen next, and then 88.73 a low of last Friday, reinforced by 55 days exponential moving average. As we can see that since bounce from 86.81 last Wednesday's low, there was no significant corrective action, and if we see the magnitude of the recent pullbacks, we can expect dips to be contained somewhere around 89, 88, 80 in order to keep immediate bulls in play for a possible extension, further extension higher, with 89, 89 break above 89.66 to open 90.00, with the further extension not ruled out. As seen on the daily chart, we have the 76.4%, pardon, weekly chart, 76.4% retracement of the larger down move from 94.97 to 75.56. That stands at 90.39. So the upside targets are at 90.00 and then 90.39, and we expect the previous high at 89.00 is psychological, and the 88.40 previous high ideally expected to contain dips in order to keep the bullish structure, immediate bulls in play. Only break below last week's low at 86.81, that is close to Fibonacci 38.2% retracement, would delay immediate bulls, and again will be signal for some a stronger corrective action, as daily studies are extremely overbought, yet no generating any reversal signal. But this is initial signal that some more significant corrective action should occur in the near term, as the pair is now driven mainly by fundamentals and comments from the central bank that turn the extremely positive sentiment among the investors, and keep pushing the Japanese yen significantly lower. Of course, the action of Bank of Japan should occur soon. We have the meeting of Bank of Japan at on 21st and 22nd of January, with the rate policy and the monetary policy to be released. We'll have more clues about further movements of the pair. And finally, from currencies, dollar Swiss attempts to base at levels just above psychological 91 level, as previous corrective action failed at 91.77, basically failing to regain initial 92.00 barrier. That is close to 61.8% of the latest downleg from 92.72 to 91.09. Negative tone still dominates, though there's some improvement seen on the hourly chart, as fresh momentum has been gained on the early morning's bounce higher that so far reached 91.50. We have immediate barrier at 91.60, 55 days exponential moving average, and 91.71, 38.2% retracement, along with the 91.77 last Friday's high, break of which, and of course break above 92 barrier is to avert immediate downside risk of possibly revisiting 91.00 and then 90.80 base, and allow for some stronger corrective action. The negative tone is still seen on the 4-hour chart, as basically the pair remains in the latest down leg is larger one is from 93 level, and the steady decline that accelerated basically on a loss of 92.00. This is a previous low, keeps the focus, near-term focus at the strong 9100 and 9080 base, sell-offs of which will be a signal for a further extension of the larger downtrend from 9970. Yes, again, several attempts on the trend line resistance failed, and the immediate reaction was fresh weakness that so far dipped to 9109. Again, more focus is seen towards the strong support zone at 9100, 9080, unless we see break above 9200 and the trend line resistance that currently stands at 9256. Break above this and the previous high at 93 is to provide the relief and the signal basing attempt. Otherwise, any other action under these levels could be just seen as further consolidation before the bears reassert for possible break below 91 and the 9080. That will open next downside target 9041 and 9000. And from energies, February crude oil remains in the near-term corrective consolidative mode following last week's stretch to 94.68. This is the highest seen so far since September 2012. The pair cleared basically 61.8% retracement of the 100.72 to 84.05. With the bulls still being in play as the initial support at the 92.60-70 zone so far contained the dips, and the more focus is again seen towards the upside. The hourly structure is now reversing. The indicators are reversing, still in the positive territory, with the initial strongest dynamic support at approximately 93.70, where we have the bullish 20-55 days exponential moving averages crossover, with another static support at 92.64. This is basically our initial support, and holding above these levels would keep immediate bullish structure in play. Still evident bearish divergence on RSI and MACD on the 4-hour chart sees a risk of possible further retracement of the strong rally from 84.05 that peaked at 94.68, and basically break below initial 92.60 support would be initial trigger towards 91.50, where is the 200 days moving average and the previous low, and the break below 91.50 and the 91.20, where is currently 200 days moving average, would confirm the temporary top at 94.68, and they allow for a further retracement of rally from 85.20 to 94.68. Conversely, break above the later is to open upside targets at 95.00 as seen as the next target round figure resistance. And finally, the yellow metal, as I said at the beginning, it holds near-term positive tone of the recent low at 16.25, better shown on the 4-hour chart, with the 4-hour structure still holding a positive tone, but again failure to clear the trend line resistance. False breaks seen last week in 2 attempts, and then a quick reversal, though the reversal still held above 1650, our initial support, and the subsequent fresh strength now sees again focus towards the upside. As said, 4-hour structure sees room for possible attack at trend line resistance, currently at 1672, and the more significant are the previous peaks at 1677, part of 78, that also marks 76.4% retracement of the down leg from 1694 to 1625, probably to break of these levels to open way towards 1694 and 1700 as a psychological barrier, clearance of which is seen as a trigger for some stronger corrective action and to avert immediate downside risk. From the other side, daily structure still holds positive tone, though the pair, the gold so far holds above 200 days moving average that broke above last week, and holding above this as initial support would still keep some positive tone and hopes for stretch towards initially 1678 and then more significant 1694 and the 1700. On the downside, loss of initial support at 1650 would risk further slide towards 1642 and then 1625. A test of 1625 would become quite likely at this point. So far, still slightly positive tone of 1625 persists, but again, clearance of trendline resistance is seen required in order to confirm this. Otherwise, this will be again described as a rather consolidative corrective action than any more significant recovery, as long as we are holding below the bear trend line drawn of the high from 1752, and they will keep focus again towards recent lows at 1635 and 1625, the later one posted on 4th of January 2012. Overall negative tone, and the bear trend continues to dominate on the yellow metal following reversal from 2012 peak at 1795, and seeing again more potential for further stretch lower, as long as we are holding below 1700 as psychological barrier and break point. And this is all from my side. Please, any questions, if you have, please, you can submit them right now. Okay, we have a question about the euro yen. It's been some time to see this instrument. Basically, strong euro and weak yen produced this strong rallies we can see on the weekly chart, following a bounce of 2012 low at 94.10 that retraced approximately, I would say, nearly 90% of the broader down leg from 123.31 peak of 2011 down to 94.10 low of 2012, with bulls being firmly in play on the larger time frames, also in the daily, despite extremely overbought conditions at this point. The pair continues to rally, especially after break above congestion seen at the beginning of January at approximately 116. Fresh break higher so far reached 120, and the main focus is now again at the recent peak at 123.31. This is the high of April 2011, as basically there is no any significant obstacle en route towards these levels, with the positive sentiment and the strong risk appetite, seeing potential for a full retracement of 123.30 to 94.10 descent, while overextended overly conditions now already are signaling a reversal. Overnight's gap, overnight's opening price at 119.65 compared to 118.91 last Friday's closing. See potential for filling up as the price dropped so far to 119.25. A break of which break below 119 is to signal some stronger corrective action, with the immediate support previous high at 118.57. This is last Friday's intraday high, and the 23.6% retracement seen as a first significant support ahead of the dynamic 118.55 days exponential moving average, as well as round figure support, and the 117.60 that marks a higher low of last Friday. Basically, this is the low of the Friday and higher low of the latest move, reinforced by 38.2% retracement. Ideally, the dips should be contained somewhere above at or above 118 level in order to keep the immediate bullish structure in play, and not to delay bulls for possible stretch towards, as we mentioned, the 123 zone. Otherwise, break below 117.60 would see the delay in the current rally and the open way for stronger corrective action. 117.00 and 116.80 seen as the next downside supports. Any further questions, please? No more questions. Okay, in that case, thank you all for being with us. We're back tomorrow morning at the same time at 8 o'clock GMT with the fresh updates, technical and fundamental. Until then, I wish you a very nice Monday is the first day of the week, and of course very successful and profitable trading. Good luck.